Yes, this is another video where I am going to go dumpster diving for a share price for a company, for a stock that has been absolutely beat up, that has been declining in share price, that I think might be a little bit oversold and is starting to make my watch list. I've covered companies like Enterprise Group, ADF Group, Kraken Robotics, Gatekeeper Systems. All of my top stocks on this channel have been performing. That means I need to go look for the next stock that I think could 100%, 200% higher, right? I need to go look for the next winning stock. And look, when I'm looking for the next winning stock, I'm typically looking for this. I made a video recently called Revenue Growth is Not Overrated, where I'm looking for the next 10x stocks. All these stocks are 10x stocks, including NVIDIA at 20,000%. And the averages of all these stocks are a revenue growth of 45.2%, a profit growth of 29.4%, and valuation growth of 23%. But look, every stock is different, and today I'm looking for that stock that is beat up, that could have a very low valuation, and I'm going to go look and see if the company deserves that low valuation. Today I'm looking at QIPT Home Medical, and what got me interested, what got this company a video on my channel, the recent drop, almost 8% drop down to $4.26 Canadian. They went from Wednesday, May 15th being at $5.40 Canadian all the way down to this price in a matter of a couple days. Market cap of 181 million. You could see recently in 2023, they were all the way up to $9.50. So basically in a year and a couple months, their share price has been cut in half. That's not good. Now, how many times have we seen this where shareholders of a company keep holding due to analyst price targets? Look at that high price target, $19.43, almost $20, an average analyst price target for QIPT Home Medical of $13 and a low of $9. They're currently at half of that. 3 analysts say it's a strong buy. 9 analysts say it's a buy. Only 2 say it's a hold. Oh, this would be painful. But before you shut the video off, there's some good things here to look at that'll be showing you today. Green is up on this slide, right? Green is up, red is down. So typically green is good, red is bad. And you could see some interesting things. Look at their revenue, up, 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 up. Every quarter consistently, their revenue is up. Their gross profit is up. Their operating income is up. And their net income this recent quarter is up. It's still a negative at $586,000, but there's still improvement. In fact, well, yeah, I know the expenses are also going up, and we'll talk about that in a little bit, right? But you get pretty consistent gross profit and revenue going up. That's a strong base to look at. When I sit back and look at this slide, this doesn't scream to me that this stock should be cut in half, right? That doesn't look like a company that should be way down here. So look, today we're going to go look at QIPT Home Medical. I'm going to show you what they do. I'm going to talk about some of the numbers, the good things, the rewards, the risks. Let's get started. My name is Cameron. You're watching Common Sense Investing. Let's go find a great penny stock. Now, do not forget, I am not a financial advisor. I'm definitely not your financial advisor. I do not provide buy, sell, or hold alerts on this channel ever. I'm just one average retail investor that likes talking stocks just like you. This is QIPT Home Medical's corporate presentation. It's relatively new in 2024. Here's their tickers in case you're interested and want to follow along. And of course, their disclaimers in case there's any forward-looking statements. Of course, QIPT Home Medical Corp is a premier provider of clinical respiratory care in the home setting throughout the United States of America. 79% is respiratory-focused product. Now, that's been able to provide them with $261 million run rate of revenue, $61 million run rate of adjusted EBITDA, dual listed, right? This is a NASDAQ and a TSX listed stock. So for a penny stock, that's pretty good. They're talking about how there's multiple growth opportunities, even though they're quite large, as the 5th largest home medical equipment provider in the country. 125 locations in 26 states, and of course, they're targeting nationwide scale, so more opportunity for growth. Diversified product offering, and while they don't have a moat on this type of stuff, there is competition. There is barriers to entry because it takes a lot of capital to be able to purchase a lot of these products, rent them out, which is what they do a lot of the time, which gives them, or at least they say, and they back back it up with their numbers, a strong recurring revenue model. With here, they're saying 83% recurring revenue, 17% new sales. As a lot of what they're selling here, their service mix, people need this for a long time. It's not something you get once and then return. You're going to need it for quite a while. And a large part of this is paid for by Medicare and private insurance. I do get a little bit tired of these slides talking about the aging population in the United States. I know there's potential there, but there could be organic growth. It isn't happening quickly, which is why QIPT Home Medical has other strategies, including strategic tuck-ins, geographic expansion, and platform acquisitions. Overall, what I'm watching more than anything is some of these microcaps and smaller companies are doing a really fantastic job of having a better technology platform than some of the legacy businesses and older companies out there. Data is everything moving forward. And if you can provide data to your clients, including your personal clients, as well as providing data to the people paying for this, insurance providers and other clients in that respect, I mean, I feel like a small company can really take advantage of being the best data provider to leverage growth that some of the other companies can't. But let's go look at the numbers. I mean, if what they do seems pretty good and doesn't really explain a share price crash, is it the numbers that have gone south that have caused the share price to just drop recently? So this is their Q1 of 2024. I believe they just released Q2. We'll go look at that. But their Q1, 60% increase in total revenue, 71% increase in adjusted EBITDA, 23% adjusted EBITDA margin, cash on hand of $18.3 million, so probably no share dilution, net debt to adjusted EBITDA of 1.3. So they have some debt to go look at. And of course, this graph is up, 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 up. Just the exponential type of growth that we're typically looking for in a small stock. However, in their second quarter of fiscal 2024, instead of providing the 60% increase of revenue, 71% increase in adjusted EBITDA, they produced revenue growth of 10% and adjusted EBITDA growth of 14%. So what changed? Well, this might be pretty important. So revenue for Q2 was $64 million compared to $58 million in Q2 of 2023. That was a 10% increase. Organic growth contributed approximately $3.3 million or 6% on an annual basis. So 6% organic revenue growth isn't exactly stunning. Why? They try to explain part of it here. The company absorbed revenue impact due to the Medicare 75-25 blended rate that's been providing rate relief in certain geographies. Additionally, the company experienced the withdrawal of Medicare Advantage members due to the capitated agreement engaged on with other providers in the industry. And now we're looking at returning to an 8 to 10% annualized organic revenue growth pace. So, I mean, tough for shareholders, right? You're going from that 60% moving along happy to now 8 to 10%, with the most recent quarter showing, admittedly here, 6% annual growth if you're not looking at acquisitions. I mean, really that explains this, right? To me, is that Q2 came out and share price went from 540 to 426. And I know what you're thinking at this point. I'm shutting off the video. What is this guy Cameron doing covering such a dumpster fire of a stock? But that's not the whole story. There's some good things to look at here. The recurring revenue is one of the main drivers, almost 80%, 79.6% is recurring revenue. Of course, those adjusted EBITDA margins, 23.3% of revenue goes to adjusted EBITDA, and they're producing cash. Cash flow from operations was $17.1 million for the 6-month period compared to $14.8 million for the last 6 months last year. So even though all the numbers, well, a lot of the numbers are heading in the wrong direction, cash is headed in a good direction. So what are they going to do with all this cash? Well, they've already talked about growth through acquisitions, expanding into other states. The other thing that they've said they're going to do is buy back their shares. This company only has 42.5 million common shares outstanding. They have an intention to buy back up to 3.6 million shares by April 30th of 2025. That's a lot of shares for a company with such a small float. I would also expect that on top of reducing the number of shares outstanding here with a share buyback. It's $96.8 million of debt if they keep paying that down. It's really an interesting stock to go look at, and I suggest you go take a look at their balance sheet and their valuations and decide whether or not QIPT Home Medical is the stock for you. I see operating cash flow here is huge, right? $42 million of operating cash flow, $40 million of leverage free cash flow. That debt, though, is a problem. Their growth now is maybe around 8%. You have to make that a consideration. But then you look at the valuation here, at least the price to sales, price to book, enterprise value over revenue, enterprise value over EBITDA, single digits. I mean, because of all the risk, because of all the problems, it has absolutely cratered their share price. One of the other problems that I have to point out, though, and another weakness, February 23rd, 2024, go confirm this because this is from HME News, is that QIPT Home Medical was the receiver of a recent civil investigation demand from the U.S. Attorneys General for the Northern District of Georgia. This is due to a False Claims Act regarding an investigation concerning whether the company may have caused the submission of false claims to government healthcare programs. The company basically said this is normal, this happens every once in a while. We'll go through the investigation, we'll cooperate with everything, we did nothing wrong, and we'll keep moving forward. So look, at the end of the day, let's put it all together. What are the rewards of QIPT Home Medical? But right now, let's start with the risks of QIPT Home Medical. Pretty simple for me. You got to be careful of buying the falling knife, right? You don't want to keep averaging down on a stock that keeps going down in share price, and QIPT Home Medical has been going down in share price for quite a while. They've shifted from high growth, talking about 60% revenue growth, 71% EBITDA growth, to talking about now 8 to 10%. You got to change all your valuation metrics. Go take a look at what you think this share price is worth. They also have that civil investigation demand from the U.S. Attorney's Office in Georgia, and they're unprofitable. They're not showing up on any stock screeners looking for that profitable growing microcap stock. However, looking at some of the rewards here and giving them their fair due, share price does keep going down. That could be an opportunity as much as it's a risk, right? That's the only reason I'm making this video today. I wasn't that interested in QIPT Home Medical at $5.40 Canadian, but now that they're down to $4.26 Canadian, could drop a little lower. I take a look at the numbers personally, and I'm wondering if the rewards start to outweigh the risk on this one. The shift from high growth to 8 to 10%, they could surprise to the upside with some acquisitions, right? That's pretty conservative. I know people were expecting more, but for a first-time kind of person looking at this company, 8 to 10% isn't bad. We just need to factor that into our models. They're producing cash. They're paying off debt. They're buying back shares. They're doing a lot of things here that should improve their value, and you can do that with cash. So as much as they're unprofitable, they're a high cash producing unprofitable company, and they're trying to reinvest back into themselves and trying to tell people that their shares are undervalued. I like the confidence. Their valuation has been destroyed by all this risk. And look, high risk, high reward play. There's no way around that. Lots and lots and lots of risks. These are all major factors. They have regulatory risks. They have unprofitable risks. They've been going down significantly in share price, right? There's all types of concerns I have here for QIPT Home Medical. However, good enough. I think the rewards are good enough to put this company on my watch list. I have to wonder if the risks have just gotten to people. They're oversold at $4.26 Canadian. I'm taking a second look at QIPT Home Medical. What do you think? Is this another one where I'm absolutely crazy, or are you also going to be looking at QIPT Home Medical? Thank you for your time. I really appreciate it. You've been watching Common Sense Investing. Hope to see you again soon.